So today I want to talk about a company stock that has fallen 50%, and I have been buying the stock. In fact, I think this company has been one of the best financial performing companies in the stock market over the past decade. So for the stock to fall 50%, obviously there were a lot of unfortunate events that happened to this company, some their fault, some not their fault, to get to where we're at today. So this company is United Healthcare, ticker symbol UNH. So if we go back a little over a year ago, so this was the first quarter of 2024, they had a cyber attack that occurred and it prevented a lot of payments that were going to be made to their customers. In fact, about 40% of the payments got stopped. And it goes back to a company that they acquired back in 2022 called Change Healthcare. And with that, they were trying to merge, all their systems together. I think there's a debate whether they could have done it faster than what they were doing. But nonetheless, the company did step up and made everybody whole and took care of everybody, which I think reflects good on, the management there. But it was a $3 billion impairment to their books, which was very, very significant. It was a one-time impairment, but it was an impairment nonetheless. All of a sudden, you fast forward 2 quarters, and unfortunately, their CEO was gunned down in New York on the way to an investor relations presentation. Again, that was just an incredibly unfortunate event, just horrific situation overall, what happened there. So then a new CEO came in, this interim CEO. He ends up stepping down just a couple months after he took the position. He'd been with the company for a while. Also, in the first quarter of 2025, the company missed on earnings. Then they reduced their earnings for this year by about 10%. Then, when the company announced that the interim CEO was stepping down, they also then pulled guidance completely in 2025, and they also had stated that the Medicare Advantage that they had really forecasted for this year, the costs were higher than what they were anticipating. And if you thought it couldn't get any worse, it did get worse. So the Center of Medicaid and Medicare Services, also known as CMS, came out and they announced that they were going to do research and try to figure out that if there was overpayments that were made for Medicare and Medicaid going back to 2018. And they even threw out a number out there that was they felt like there was overpayments of about $3.7 billion in 2023. So there's numbers, circulating out there that it could impact United Healthcare all the way up to $20 billion potentially if CMS comes back and says that, yeah, we made overpayments to United Healthcare and these other companies, we want some money back, and they try to claw it back. So obviously a lot's happening with United Healthcare. There's a lot of stuff that is unknown right now. There's a lot of uncertainty. There's a lot of fear in the market. That's why the stock has fallen 50%. So why in the world would I want to buy a company, United Healthcare, that's going through all these issues right now? And it's a fair question. It's a fair question for myself. And for me personally, I just think, I do think there's risk, certainly with the regulatory environment. But I also think there are things that are just kind of overblown right now because there's so many things that have happened with United Healthcare. I just feel like there's just been a lot of stuff that's getting piled and piled on to the point where the market, and a lot of investors have just gotten out and it's just sent the stock, all the way down. And for me, when I look at the financials over the last 10 years and what I think the company's could do over the next, several years, I still think they're in a pretty good spot. So let's go take a look at financials over the last decade, and then we'll get into what, fair value of the stock is based on some future assumptions. So let's go do that now. So on the screen, you can see the big 5 numbers for the company. This is sales, earnings, free cash flow, book value, and also return on invested capital. The company has grown a market cap of $100 billion 10 years ago, all the way up to about $550 billion at one point. And today it's trading at $275 billion. Now, over the last 10 years, the company has grown sales roughly 11% per year. And this is a compounded annual growth rate. Earnings per share has grown also around 12%. Free cash flow has grown around 11%. Book value per share has grown around 13%. And return on invested capital has averaged 12%. So obviously, all these numbers look really good. I mean, you're talking double-digit growth for sales, earnings, free cash flow, book value. But for me personally, I really like to look at the book value per share and seeing that grow for United Healthcare at a 13% growth rate because very similar to banks, insurance companies generate their money with assets on their books, with the money that they're getting from their customers that they can put on the assets of their balance sheet. That is what they can drive revenue for the business. And book value per share is basically equity of a company. And so, with it growing 13% per year on average, that really gives me a good feeling that management knows what they're doing, especially the return on invested capital being over 10% as well. Next, let's take a look at some balance sheet metrics for the company and a couple other metrics as well. Now, as far as long-term debt payoff for the company, they can pay off all their long-term debt in less than 3 years based on their operating earnings of the business, which is fantastic. Their debt to equity is 77%, which is fantastic. On average, the market has been willing to pay a PE of 20 over the last 10 years for this company. Currently, they're actually trading at a 12. The 17 is actually out of date. They're around a 12 or a 13 currently, so well below what their average has been. Now, as far as operating income for the business, operating margins for the business, they've averaged 8% over the last 10 years, and they've been very, very consistent, really between 7 and 9% over the last 10 years. So overall, their balance sheet is in really good order. This is a company that has been very, very consistent, and they have some of the best margins in their industry. I mean, you're talking operating margins of around 8%. A lot of companies in their industry are around that 3 to 4%. So their operating margins are almost double what a lot of their competition has been, which has been driving a lot of the return on invested capital, a lot of their earnings per share as well. So now let's go take a look at what I calculate as a fair price for this stock based on some assumptions that I make, which we'll go over. So let's go do that now. So on your screen now, you see my discounted operating earnings model. So what I'm doing here is I am going to forecast the company's revenue over the next several years. So I think they're going to be around $445 billion in revenue this year, which is pretty much in line with what management is saying they're going to do. And then I think it's going to grow to about $600 billion in 2029. So that is roughly an 8% CAGR on the top line for the company over the next several years. And we saw previously that they've been growing over double digits. Now, as far as an operating earnings for the business it goes, I think this year they're going to be around 6.5%. They've been around 8% historically. I think it is going to drop. I think with the Medicare Advantage, them mispricing that this year, I think they're going to have some margin suppression. It probably will be in the sevens, but I'm going to be really conservative and say it's around 6.5% this year. Now, going in 2026, I think that's when it's going to get interesting. I am assuming that there's going to be an impairment on their books at some point because they're going to have to pay back some of the Medicare or Medicaid clawback that the government is going to do research on and figure out if there's any overpayments. So I am going to assume that a good chunk of their operating earnings next year is going to be diluted because of that clawback. It may not happen at all, but that is what I am going to assume, dropping all the way down to 2%, which would be the lowest operating margin the company has seen for many, 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 many years, going back well over a decade. From there, I think they're going to start recovering, getting back to more of normalcy for the company. I think, with insurance companies, with them repricing going into next year, we're going to see probably towards the end of 2026 into 2027, operating margins recover about 7%. I think they're going to continue to recover over the next 2 years, getting up to the historical averages around 8% in 2029. So I think that is roughly an 8% operating earnings growth from the bottom line. I also think the company's going to buy back around 2 to 3% of their shares over the next 5 years as well. So that gives me an intrinsic share price for the stock at $429. Currently, the stock, as I do this video here today, is trading at $304. So the stock is trading at a 30% margin of safety based on these assumptions that you see in front of you. So again, I think the intrinsic value of United Healthcare is roughly around $430. Now, if I think things are going to get even worse than they are right now, and let's say that they never return to their 8% operating margins that they've been historically over the last decade or so, and say they're going to be around 7%. Well, that changes what the fair price of the stock is. And I think the stock at that point is between $300 and $340 a share right now. So still, trading at a margin of safety, but not much. In fact, you could probably say it's trading at closer to fair value as it stands right now. But I do think that they're going to make some changes to the Medicare Advantage going forward. I think the issues with the clawback from the government, I think that's going to be a one-time thing. And I just think that this is a long-term play for me. And that's why I am buying into the company. I'm not looking at what's going to happen this year, what's going to happen next year. I'm looking even 2, 3, 4 years out into the future. And I'm willing to hold this company because I think it is a really, really good company that's gone through a lot of events, some their fault, some not their fault, and that this company is going to recover long term. I could be completely wrong. There could be more, clawbacks from the government. There could be more bad news that happens with the company. Maybe instead of missing earnings by 10% this year, they miss it by 20%. Who knows what's going to happen? But that's why, again, I like to buy at a margin of safety to give me some cushion overall. And if you don't know how to value stocks, it's one of the most important evaluations of a company. You got to know what a company stock is worth. If you're interested in that, I do go over that on my Patreon. I provide my own templates as well. So the discounted operating earnings model you saw today, I do provide that along with a couple other valuation templates as well. And I have a video on there explaining how to use that yourself so you can go out there and value companies as well. And it's not just valuing companies. You need to understand what the business does. You need to understand their moat, their competitive advantage, all that stuff as well. Incredibly important. You got to put the time in overall to really, I think, beat the market and put yourself in a good place moving forward. So hopefully you enjoyed the video. Hopefully this was valuable to you. I like United Healthcare. We'll see how it plays out. Only time will tell. Thanks for watching. Really appreciate it. Catch you on the other side. Take care and God bless.